Hello there, welcome to this edition of Global Business Africa. Over the next 30 minutes, we'll have an incisive look at all the key business stories making headlines right across the continent. If it happened in any of these four cities behind us, Cairo, Johannesburg, Lagos and Nairobi, we've got you covered. Here's what's coming up. The Alliance for a Green Revolution in Africa Forum 2014 continues. We'll have perspectives from Kenya and South Sudan. Speaking of Kenya, East Africa's biggest economy set to lose preferential access to the EU. And we'll be telling you why Ugandan farmers are falling in love once again with vanilla. We start tonight with logistics, specifically revenues from Egypt's Suez Canal. They breached the $500 million mark in August, making the highest monthly revenues on record. The Suez Canal Authority Chairman Mohab Mamish said that 2014 is set to be a record year for revenues for the fastest shipping route between Europe and Asia. President Abdel Fattah el-Sisi has made the canal a centerpiece of his vast new public works program, which is designed to bootstrap Egypt's ailing economy. A 34-kilometer channel parallel to the current one will be built to allow two-way traffic to run along the canal. Sections of the existing one will be widened and deepened, and rail tunnels will be dug underneath. State-owned banks are preparing to issue non-tradable 5-year investment certificates open only to Egyptian buyers to raise the over $8 billion needed for the project. Now, agriculture is a bit of a theme in this part of the bulletin. A crippling lack of finance is one of the main barriers to higher agricultural productivity in Africa. Financial institutions, commercial banks especially, often accused of failing to lend SMEs cash for a variety of reasons. Kenya's Equity Bank, however, aims to improve access to financial services and credit to farmers. Its chief executive, James Mwangi, argues that lending to farmers can be a win-win proposition for both parties.
7% of the total lending of Equity Bank is in agriculture. Equity has 183 agroeconomists who do nothing else other than support. The most important thing is to build capacity of the farmers. And agriculture is not going to be transformed without massive resource allocation. The way we are transforming transport, the way we are transforming infrastructure by massive investment in roads, railways, ports and harbors, that is how we need to approach agriculture.
Now, South Sudan, of course, is better known these days for oil and more commonly for a fairly brutal civil war that's been running since December. That said, Africa's youngest state has plenty of virgin agricultural land and one of the world's biggest pastoralist communities. Now, between the discovery of oil and the civil war, agriculture in South Sudan has often been a neglected sector. Authorities in Juba, however, now hope to jumpstart the sector by introducing a raft of new policies, some of which include incentives to the youth and female farmers.
Yes, the country is blessed with oil. Yes, blessed also with other natural sources like gold, uranium is there, and other resources are available in the country. Oil is there, but this is not an issue. The oil, should there be anything come out from the oil, should be the one how to subsidize agriculture, because agriculture is the foremost. If we subsidize agriculture, then immediately our farming population, who are the majority, will immediately be producing enough food on their own. And that's why we are calling international investors to come and support these smallholder farmers so they can produce their own food together with the international investors. So it is very important to look into it that should we achieve this and everybody has a food, immediately the towns and the area will prosper.
Climate change is a fairly hot issue at AGRA's annual conference this year, specifically the thorny question of how millions of Africans will be exposed to food insecurity in the near future as a direct result of climate change. With the right adaptation, however, African farmers can avert a catastrophe. From the Ethiopian capital, here's Jen Keo.
We also want to thank
No farming summit these days is complete without some report on climate change, and this one's no different. Whatever your take on the issue, the experts here are in little doubt. Well, this report by the African Green Revolution Alliance says climate change will slash food output. Within the next 30 years, the number of malnourished people in sub-Saharan Africa could jump nearly 40%. Already temperatures are rising. Delegates here say farmers must adopt so-called climate-smart agriculture.
Therefore, if mankind is to seriously address climate change, which we must, then we must change the way we do agriculture so as to drastically reduce its contribution to climate change.
It means a rethink in the way farmers use the soil and the water, and rethinking what to grow. For example, drought-resistant crops like sweet potatoes, cassava and sorghum, rather than maize, which is more vulnerable to climate change. Almost 2/3 of the world's remaining arable land is on this continent, so it's an area Africa needs to take the lead on. So far, though, delegates here say many governments have yet to give farmers the support they need.
Policy at the national level still are not aligned to enable African farmers to reach their full potential. And in certain countries, governments are focused on Africa, so I think that's important, like Nigeria, Kenya, Ethiopia, Rwanda, and here there are good growth rates and a certain amount of poverty reduction as well.
The result, Africa currently spends almost $100 million every day importing food, and very few farmers are planning for climate change. Jean Keo, CCTV, Addis Ababa, Ethiopia.
On the penultimate day of the Agri-Conference in Addis, we sought to find out what plans there are to translate the ideas from the event into concrete policies and high output from Africa's millions of small-scale farmers. When Girum Chala spoke to Jen Kiruku, president of the Alliance for Green Revolution in Africa, their conversation started by him asking her, after all is said and done and the conference is over, what happens next?
Gathering is very important, like you've picked during the day. We have 1,000 participants from about 60 nationalities or 60 countries. And what is happening, we are starting to build the traction in terms of the conversations and also building partnerships that are then going to take serious activities or more impetus in terms of the issues that we need to address in driving African agriculture. The participants, as you've discovered, is governments, African Union, private sector, both large and small, policymakers, i.e. politicians are also present, and farmers as well. I think we heard from Farmer Group leader this afternoon.
Based on the decisions made to transform African agriculture, don't you think there is a lot of need of commitment from the African states so that what has been agreed before can be implemented?
This is a forum right after the Malabo Declaration, where governments are again committing about increasing their investment in agriculture. They've also committed to reduce poverty and to increase productivity in their own countries. So I must say that there is a lot of discussion, a lot of traction within governments and policymakers themselves. And I think in any country that you visit right now, the issue of agriculture and investment is really, really topical. So we are seeing a lot of activity and a lot of commitment from governments, but of course time will tell in terms of how we actualize those commitments.
There's no denial that the private sector's involvement in making African agriculture grow is vital. According to your opinion, how should that be implemented and be part of the African agriculture transformation at this time around?
All these initiatives need sustainability. In order for sustainability to happen, we must have investment. Investment comes from private sector, both local as well as international, both small and big as well. So investment is starting to pour in Africa, because if we make agriculture positively profitable, then there is a lot of, it's very convincing that all of us need to invest. As a farmer, as a government, as a private investor, or as a multinational.
All right, then a quick run through the equity markets here for you. Let's see what your money has been doing. Fairly positive day across the board, except for the Nigerian All-Share Index. South African equities are posting gains for the third straight day of trading, tracking, of course, the rise we've seen in global indices. Elsewhere, some strong numbers coming out of Discovery Health. Their full-year pre-tax profits up by about a quarter. And Mr. Price, of course, 4-month sales up 16%. That essentially breaks expectations you should expect with consumers, with the rather household debt levels in South Africa being where they are, and the effect that will have, of course, on household spending. plenty more coming up. We'll be looking at Kenya's odds of losing preferential access to the EU next. And South Africa is considering electronic visas to keep tourists coming into the country. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies.
From small businesses to large-scale enterprises, hear directly from entrepreneurs behind the story. It's about putting you in the picture so you know where Africa fits in the global context.
Global Business, weekdays at this time on CCTV Africa.
Welcome back. You're still watching Global Business Africa. Now, from October, Kenyan exports to the European Union will face higher import taxes given the failure to conclude trade talks between these two sides on time. While the EU has made an allowance of about 3 more months for extended talks on an economic partnership agreement, the deadline for the imposition of taxes remains as is. Here's Mahia Moto with more.
Kenya exports around 85% of its agricultural products to the European Union. From flowers, fruits, vegetables, coffee and tea, these products are tax exempt following an economic partnership agreement that expires on the 30th of September. And for the last 8 years, protracted talks have failed to reach a deal defining a renewed partnership agreement. Without it, Kenyan goods lose preferential access to the European Union.
Kenya will have to pay import taxes because we have to go through a small legislative procedure within the European Union, which is called the Delegated Act procedure. That is a decision that can be taken by the European Commission. It's an exclusive competence from the European Commission, but still it needs the consent from the Council of Ministers and the European Parliament.
The Economic Partnership Agreement was negotiated by the East Africa community as a whole with the European Union. All other East African countries apart from Kenya are categorized as least developed economies, allowing their products continued preferential treatment in the European Union.
And the problem with the EAC, you all know it, 4 countries are LDCs. They continue to benefit from it, everything but arms system, but only Kenya is the only non-LDC, and which will have to face GSP tariffs as from the 1st of October.
The EU has also accused Kenyan farmers of using too much pesticide in horticulture produce and warns it might consider a ban if farmers don't comply with their given standards.
The rules that we apply, the sanitary rules that we apply in the health, they meet international standards in the sense they are transparent and they are science-based. In addition, and that is very important, they apply to European producers and importers alike. That is to say that European producers have to meet exactly the same standards.
The looming deadline for the loss of duty-free and quota-free status has the industry worried, though the Kenya government says it is doing everything it can to avert the imposition of tax on Kenyan goods.
We anticipate success. And even to our farmers from this channel, I want to give them courage and give them hope that they continue to do their farming and observe all the standards that the government has given them, and for sure their business will continue.
The European Union is Kenya's biggest export market outside of Africa. However, with the introduction of the new taxes, East Africa's biggest economy might just have to look for an alternative market or consider paying the taxes altogether. Mahia Mutua, CCTV.
South Africa recently announced changes to its visa application process, which, according to its government, will curb international child trafficking. As Angelo Coppola tells us, that certainly may be the case, but the new regulations will also affect tourist and business traffic.
The African tourism sector could lose as many as 270,000 visitors to our shores if the new regulations are implemented as they currently stand. This could cost the country an estimated $900 million in revenue.
The government has announced these new regulations to come into effect the 1st of October, and since then we've seen a decline, about 70% decline from markets such as China.
It's going to be another knot in the string and make it difficult for people to travel in and out of South Africa, and we rely so heavily on our tourism industry.
Meanwhile, the Democratic Alliance launched a petition on Friday urging the Tourism and Home Affairs ministries to introduce electronic visas for tourists. This after several attempts by the official opposition to engage with the Home Affairs Minister to consider other options. The response has been overwhelmingly positive to the petition.
We are very glad to see that our proposal has been welcomed by industry and by the public locally and abroad. And that's precisely what we want. We want to show to government that there are other alternatives, such as electronic visas, to facilitate and streamline tourist applications to your country.
Many are concerned about the unintended consequences of the new regulations, which could affect continental relationships.
And then, of course, there's the tit-for-tat reaction. Mozambique has already introduced a cost for travel for business reasons for visas, cost in the region of R1,000, and Kenya is also implementing the tit-for-tat things.
There is also the potential risk to South Africa's neighbours and their economies.
And if we as a country are putting regulations in place to make it more difficult to attract tourists to our country and to facilitate the tourist visa application, then it will most certainly impact on our neighbouring countries.
If you have a look at the tripartite free trade area with COMESA, EAC and SADC, it's going to put quite a block on the viability of that trading bloc.
In a country where unemployment is a huge social issue, there is the question of tourism-related employment. Several studies have been commissioned and they don't paint a pretty picture.
We have commissioned various studies. The Tourism Business Council of South Africa has also commissioned a study, and 21,000 jobs annually will be cut if these regulations come into effect.
South Africa's economic growth rate is expected to be around 1.5% for the year. And for a country with this kind of pressure on its economic growth, the new visa regulations are expected to add more downward pressure, something the country can ill afford. Perhaps what's needed now is open communication between the tourism industry and the Home Affairs Department to find some kind of resolution and compromise. I'm Angelo Coppola for CCTV in Johannesburg.
As far as commodities are concerned, not much of a change from what we've seen over the last couple of weeks in which we've been tracking some of these commodities here. A bit of a recovery, however, in crude oil prices, 102.28, the relevant number over there. Tangentially related to that, Somalia is accusing oil explorers operating on its territory of destabilizing it. The issue at heart here really is the fact that you've got the government issuing one set of licenses and then other territories like Puntland, Somaliland issuing others. When we come back, we'll be looking at Kenya's debt levels. It nearly doubled beyond its target in the last fiscal year. And we'll be telling you why Ugandan farmers are falling in love with vanilla again. Welcome back. Kenya's government overshot its domestic borrowing target by 90% in the last fiscal year, effectively doubling the amount it borrowed from the local market to over 4% of GDP. In June 2013, Kenya's Finance Minister Henry Rotich forecast that he would borrow just over 100 billion shillings from the local market. By the end of June this year, however, he'd borrowed almost twice as much. Now, if external investors were concerned, they certainly didn't show it. The country's debut $2 billion Eurobond this year pushed Kenya's public debt to GDP ratio to 57% of GDP, and that was oversubscribed. A rebasing exercise due to conclude this month by the Kenyan Statistics Bureau, however, might eventually reduce the debt to GDP ratio for East Africa's biggest economy. Now, from the perspective of Kenyan taxpayers, however, how concerned should they be about this rise in public debt and the knock-on effect that has on how their taxes are spent? Deloitte's tax director for East Africa, Nikhil Hiri, is with me in studio now to unpack the numbers. How big a concern is this for you, the doubling of domestic borrowing last year?
Well, huge, in fact, because clearly the more your debt is, the more interest you've got to service, the higher your government expenditure is going to be spiraling. And Rama, you and I have talked about government expenditure many a time over the years, which is continuing to spiral, and yet the revenue is not really keeping track with that. We're yet to expand our tax base. We're still going after the same taxpayers over and over and over again. And I think with an increasing debt that is going not to service development necessarily, but actually going to service recurrent expenditure, then that's an issue, I feel. And it's not good in the long run for the country.
Is this perhaps the reason why we're seeing a lot more emphasis, a lot more attention being paid to efforts to revive capital gains tax? Because there's been a lot of noise in Parliament and in the Executive about reviving that in the last couple of months.
In fact, from what I can gather, it has been revived. Parliament passed it the other day. I haven't seen a revised finance bill, just followed what it was in Hansard. But you're right. Attempts have been made in the past. I think 2006 they made an attempt, 2011 they made an attempt, and both times it was thrown out by Parliament. This Parliament has obviously taken the view that it's needed. And I guess it links back, as you say, to increased public expenditure, part of it coming from the debt, the increased debt, high civil service wage bills, that we need additional sources of taxation. And the argument has always been that we've got a significant number of pregnant gains sitting around in the country, a lot of speculative deals going on, and the attitude seems to be, well, why aren't we taxing it? And capital gains tax seems to be
I guess with respect to East Africa, Kenya's been the outlier by not charging CGT, and a lot of the people you talk to in the private equity industry tend to say, yeah, but this is one of the main things that attracts us to coming in here. But if we reintroduce CGT, aren't we essentially taking away a competitive edge?
Well, yes and no. Yes, I agree that there could be a drop in NSC from foreign investors. There could be a little bit of curtailing by the private equity investors. But I think on the flip side, if you read what they're planning to introduce, it's actually a 5% tax on the net gain. So it's not a huge tax in terms of the quantum of the rate when you compare it to other parts of the world, which are normally at the corporate tax rate. So from that point of view, I think we're okay. Where we're not okay, and this is something that I've said repeatedly, that if we're going to reintroduce capital gains tax, we must have some indexation. And what scares me is that they've said it's coming in on the 1st of January 2015. So presumably there'll be a lot of transactions happening between now and then. But if you haven't done any transactions between now and then, and you sell in 2015 an asset that you may have bought 40 years ago, can you imagine how much of your gain is because of the inflationary element?
It's going to be an absolute nightmare. One last question for you very quickly. Mr. Rotich sought to raise $15 billion shillings with the rail development levy that he introduced in the budget. Last year, he beat that by about 4 billion shillings or so. But given that Kenya's been stuck in this 4% growth rate for a very long time, how do we explain that rise?
Well, what is Railway Development Levy? It was designed to tax imports into the country for home use. So goods in transit were, of course, exempted. But what's our major import? Fuel. And when you think of the amount that we spend every month on purchasing fuel, and all that is subject to this 1.5% railway development levy, it proves the point that we're a very import heavily reliant economy. Not a good thing. We need to get our act together and build up manufacturing capacity.
Indeed. We'll have to leave there, unfortunately, for the time being, but a pleasure having you here as always.
Thank you, Rama.
Thank you very much for that. That's Nikhil Hira. He's the tax director for Deloitte in East Africa. Now, speaking of East Africa, rising global vanilla prices are encouraging Ugandan farmers to grow the crop once again. Many had abandoned it decades ago when prices fell. As Leon Sanyanga reports in Grassroots Tonight, however, they're falling in love with vanilla once more.
A drastic drop in prices of vanilla on the world market greatly affected George Serenkuma's earnings from the crop. He said he won't rest until he gains what he lost a decade ago.
I started growing the vanilla long after my fellow farmers had started. Unfortunately, That's when the prices dropped.
Between 2003 and 2004, the price of vanilla spiked to $25 for every kilogram, pushing a number of people to plant the crop. Serunkuma is among the many vanilla farmers who shunned the crop after prices fell to less than $1 for a kilogram. That was barely enough for farmers to survive. Up until 10 years ago, vanilla was being grown on a large scale, but its commercial success was short-lived after prices plummeted. Now that the price has stabilized, farmers are generating healthy profits from growing the crop. Now, a kilogram of vanilla goes for about $12.
I'll now work hard and hope to get some profits now that I'm growing my plantation again.
Uganda's Export Promotions Board attributes the rise in prices to the growing demand from the food industry that uses it as a spice, and farmers are now struggling to keep up with demand.
We cannot meet the target. Those people want a lot of vanilla because our vanilla blends other vanillas in the world. We are still so natural that we don't mix things. So we are competing in terms of quality because our vanilla has no impurities.
Uganda remains one of the top 10 vanilla producing countries, bagging $2.6 million from the crop last year. Most of the country's black gourmet vanilla is exported to Europe, with vanilla extracts sold to the Americas. Leon Sanyange, CCTV, Mukono, Central Uganda.
With respect to currencies, one key story you definitely need to know about today. Kenya's central bank decided to hold rates, the base lending rate rather, at 8.5%. The bias moving forward, however, will be towards much tighter liquidity management. The key to watch, however, is how CPI behaves between now and November this year. That, of course, might inform a rate hike moving forward. Of course, we might see a moderation as well next month because of the base effect coming in between September 2014 and 2013 when the VAT Act took effect. Now, later on tomorrow on Global Business, the Alliance for Green Revolution in Africa Forum will close in Addis Ababa. We'll have the resolutions, the ideas, the opinions coming out of that. And of course, Hyundai is also launching a new plant in South Africa. Plenty of motoring news will be coming your way actually tomorrow, so plenty to look forward to altogether. But that's it for this edition of Global Business, and your feedback on the program to Global Business Africa at cctv.com, wherever you are online, Facebook and Twitter. We're there. We'll keep you posted on developments right across the continent. But that's it for the program. Thanks for watching. I'll see you in 23 hours. I'm Ramanya.